Looking at the markets right now, oil fell for a second straight day, now at $78 a barrel this morning. This is a bit unexpected as a jump in U.S. gasoline supplies cast doubt on the strength of recovery in crude demand. The EIA said yesterday gasoline stocks rose by 1.7 million barrels last week. Analysts expected a fall of 1 million barrels. Checking prices, as you just saw, crude is up 59 cents a barrel, natural gas down 11 cents on the day. With us now for a closer look at the oil and natural gas inventories and the markets ahead is our good friend Elliott Gue, who is editor of the Energy Strategist and the Energy Letter. Elliott, good Thursday morning to you.
Good morning.
Let's start with yesterday's results. A pretty good build in stockpiles for oil, and we saw the effects on prices yesterday.
Yeah, definitely. The gasoline number was what really people concentrated on. That was expected to be a drawdown in inventories, and it was a pretty big build. Oil and distillates were actually a little bit larger declines in inventories than had been expected. So it was really kind of a mixed report, but the market really seized on that gasoline number.
Just within the last half hour or so, Elliott, the new U.S. numbers are out about economic growth, a 3.5% jump in the economy over the third quarter here in the U.S. Do you see the effects extending through the day in terms of oil trading?
You know, that's an interesting number. It was really expected to be around 3%. And earlier this week, actually, Goldman Sachs came out and cut their estimate from 3% to 2.7%. And that actually did have an effect. You could see it immediately in the oil market when they cut that estimate. Obviously, a very influential investment bank. This looks to be, quite a bit better than expected. Obviously, it is the advanced read. The third quarter has only been over for a month now. And we're going to get probably some pretty big revisions as the later numbers come out. But that's definitely putting a positive tone to the pre-market for both oil and stocks.
Pulling things down, though, Elliott, more economic news. The jobless claims did not drop as much as expected. There's also the issue of growth overall and tempering things. The U.S. dollar still seems to be a problem. What's the driving force right now? Because clearly it doesn't seem like demand is number one.
Well, I think a lot of people are looking at the stock market and saying, the stock market obviously recently hit new highs. We've pulled back here over the last few sessions, but the stock market's really looking at corporate earnings right now. And you are beginning to see some signs of actual revenue growth out of a lot of companies. A lot of them really in the technology sector have been showing some growth, and that's really been powering the stock market higher. The oil market sort of following the stock market because both of them are discounting the potential for an economic recovery. So you've really seen oil very highly correlated with stocks. We had a big run up to new highs earlier this month, and both have corrected since then. So I think what's really going to be crucial over the next few weeks is as we get the second half of earnings reports out of S&P 500 companies. Are there any signs of actual revenue growth? Is it not just cost cutting and laying off people, but is there actual revenue and sale growth?
We are just about an hour away, Elliott, from the EIA releasing its numbers on natural gas for last week. And you told me you're expecting yet another build, and I don't know why we'd expect anything different after the months we've been following lately.
Absolutely. We'll probably still see builds for the next few weeks. Really, the beginning of the winter heating season doesn't normally start until we get into November. We've had some pretty weird weather in the United States so far this month. We've had some unusually cold weather earlier in the month. Last week's number was a smaller build than had been expected. It's really the most bullish number we've had in about 3 months. This week we've had some warmer weather around the country, especially in the primary gas consuming regions. So I expect to be a little bit bigger build. The real question is what's going to happen after mid-November as we start moving into the heart of the winter heating season. It's really, the Weather Service has come out and said essentially that there's about equal chances of it being a colder than normal winter or slightly warmer than normal winter. So a lot could hinge on that. And then, of course, gas is also looking at this GDP number and the potential for an economic rebound, because most of the decline in natural gas demand over the past year has been industrial demand. And so it's going to be really key to look at if that really starts to bounce back. We did get an industrial production number last week, and industrial demand for natural gas is highly correlated to that, and that was better than expected. So one of the reasons you've seen gas trade up sort of towards the high end of its yearly range is because of, again, the same reason as oil, really that expectation that the economy is bouncing back, and that's going to help industrial demand.
Final question, Elliott. Saw some comments recently from an analyst who specializes in nuclear generation financing. And he was saying that anywhere above $7 in terms of pricing for natural gas, that's when nuclear generation really becomes appealing and is most cost effective as a competitor to natural gas generation. Do you have a price in mind that you're hearing from the gas industry where it wants to see prices settling through the rest of the year?
Yeah, I think that that $6 to $7 range for natural gas is really a key area. It really depends upon what plays you're looking at. If you look at and the figures vary widely, but most of the numbers I look at say that some of the shale plays, in particular the Haynesville Shale and the Marcellus Shale, are probably economic at lower gas prices, and that's one of the reasons you've seen, for example, the rig count in Louisiana, where the Haynesville Shale is located, be actually rising in recent months, even as the rig count overall for the country has been flat or very, very weak. But a lot of the conventional production in places like Texas, which remember accounts for still the majority of U.S. production, or certainly a large portion of it onshore, that you really need $6 or $7 gas, or in some cases much higher than that. So I really think that a lot of these companies, especially as we move into next year, you remember most of them have already hedged their production for 2009, and most of them have hedged their production for the very first few months of 2010. But as we move into 2010, you're going to need to see $6 to $7 gas to sustain any sort of a stabilization or recovery in the rig count. And I think that as we move into early part of next year, we could see U.S. gas production falling very sharply as a result of the lagged effect of that decline in the rig count over the past year. And you're really going to need to see gas move back up sustainably in that $6, $7, even $8 range to convince these companies to come back and start drilling again.
The EIA report due out a little later this morning. As our usual Thursday guest, Elliott Gue predicts another build is on the way. Elliott, thanks again for joining us. As always, we'll see you back here next week.
Thank you very much.